Welcome to our comprehensive guide on managerial accounting, where we'll explore three critical areas that drive business success: budgeting, cost analysis, and performance evaluation. Managerial accounting is a vital tool for business leaders, providing the insights needed to make informed decisions, optimize resources, and achieve strategic goals. In this video, we'll delve into the intricacies of creating effective budgets, analyzing costs to improve profitability, and evaluating performance to ensure alignment with organizational objectives. Whether you're a seasoned manager or new to the field, understanding these concepts will equip you with the knowledge to enhance operational efficiency and drive business growth. Let's get started on mastering these essential managerial accounting skills. 1. Budgeting. Budgeting is the process of creating a plan to manage your finances, typically for a specific period, month, quarter, year. In managerial accounting, budgeting helps managers plan and control financial resources to achieve business objectives. Types of budgets. Operating budgets focus on day-to-day operations. Includes sales, production, and administrative expenses. Example: a monthly sales budget and a monthly expense budget. Capital budgets, concerned with long-term investments. Includes expenditures on assets like equipment or buildings. Example: budget for purchasing new machinery. Cash flow budgets track the inflows and outflows of cash. Helps ensure there is enough cash to meet obligations. Example: monthly cash flow projections. Budgeting process. Planning, set goals and objectives. Forecast revenues and expenditures. Prepare detailed budgets for various departments. Forecasting, use historical data and market trends to predict future performance. Adjust forecasts based on changing conditions. Monitoring, compare actual performance with budgeted figures. Investigate variances and take corrective actions if needed. Types of budgets. Fixed versus flexible budgets. Fixed budget remains constant regardless of activity levels. Simple but less adaptable. Flexible budget adjusts for varying levels of activity. Provides a more accurate performance evaluation. Zero-based budgeting, ZBB, starts from zero base each period. Every expense must be justified. Useful for eliminating waste but can be time-consuming. Incremental budgeting based on previous periods' budgets with incremental adjustments. Easier to prepare but may perpetuate inefficiencies. Budgeting techniques and tools. Rolling budgets, continuously updated, usually quarterly. Helps to stay current with changing conditions. Top-down versus bottom-up budgeting. Top-down, senior management sets budget targets. Bottom-up, budget created by department managers and aggregated. Both approaches have advantages and can be combined. Budget variance analysis identifies and analyzes differences between budgeted and actual performance. Helps in understanding why variances occurred and making adjustments. 2. Cost analysis. Cost analysis helps in understanding the costs of producing goods or services and their impact on profitability. Cost classification. Fixed costs versus variable costs. Fixed costs do not change with the level of production, e.g., rent. Variable costs vary with production volume, e.g., raw materials. Direct costs versus indirect costs. Direct costs can be traced directly to a product or service, e.g., direct labor. Indirect costs cannot be traced directly and are often shared, e.g., utilities. Product costs versus period costs. Product costs associated with production and included in inventory, e.g., direct materials. Period costs expensed in the period incurred, e.g., office salaries. Cost volume profit, CVP, analysis. Break-even analysis determines the sales level at which total revenues equal total costs. Formula: break-even point equals fixed costs selling price minus variable cost per unit. Text: break-even point equals frac text fixed costs text selling price text variable cost per unit. Break-even point equals selling price minus variable cost per unit. Fixed costs. Contribution margin represents the portion of sales revenue that exceeds total variable costs. Formula: contribution margin equals sales minus variable costs. Text: contribution margin equals text sales. Text: variable costs. Contribution margin equals sales minus variable costs. Margin of safety measures the amount by which sales can drop before the business reaches its break-even point. Formula: margin of safety equals actual sales minus break-even sales. Text: margin of safety equals text actual sales. Text: break-even sales. Margin of safety equals actual sales minus break-even sales. Activity-based costing, ABC, concept and benefits allocates overhead costs based on activities that drive costs. Provides more accurate cost information. Implementation steps identify activities and their cost drivers. Assign costs to activities and then to products based on their use of activities. Cost behavior and estimation. Cost behavior patterns. Costs can be fixed, variable, or mixed, semi-variable. Understanding patterns helps in forecasting and budgeting. Cost estimation techniques. High-low method uses the highest and lowest levels of activity to estimate variable and fixed costs. Scatterplots, visual method to analyze cost behavior. Regression analysis, statistical method for more accurate cost estimation. 3. Performance evaluation. Introduction to performance evaluation. Performance evaluation assesses how well an organization or individual meets its objectives, using various metrics and tools. Key performance indicators, KPIs, financial KPIs. Profit margins measures profitability, e.g., gross profit margin, net profit margin. Return on investment, ROI, measures the gain from investments relative to their cost. Non-financial KPIs. Customer satisfaction, metrics like Net Promoter Score, NPS. Employee turnover, measures employee retention. Performance measurement tools. Balanced scorecard provides a comprehensive view by evaluating financial and non-financial aspects. Includes perspectives: financial, customer, internal processes, learning and growth. Benchmarking. Comparing performance against industry standards or best practices. Helps identify areas for improvement and set performance goals. Variance analysis. Analyzing the differences between actual and budgeted performance. Helps in understanding reasons for variances and making informed decisions. Management by objectives, MBO, concept and implementation. Setting specific objectives with measurable outcomes. Aligning individual and organizational goals. Performance reviews. Regularly reviewing progress toward objectives. Adjusting strategies as needed. Performance reports and dashboards. Types of reports. Financial performance reports include income statements, balance sheets. Variance reports show differences between actual and budgeted figures. Effective reporting techniques use visual aids like charts and graphs. Ensure clarity and focus on actionable insights. Recap of key points. Summarize the importance of budgeting, cost analysis, and performance evaluation in managerial accounting. Highlight how these tools aid in planning, controlling, and improving business performance. Importance of managerial accounting. Emphasize its role in strategic decision-making, cost management, and performance enhancement.
The balance sheet is one of the essential financial statements that reflects the financial position of a company at a specific point in time. It is also known as the statement of financial position. This statement consists of three main parts: assets, liabilities, and equity. Assets include everything the company owns, such as cash, inventory, accounts receivable, and property and equipment. Liabilities represent the financial obligations of the company and include loans, accounts payable, and other payables. Equity shows what remains of the assets after deducting liabilities and includes paid-in capital and retained earnings. The purpose of the balance sheet is to provide a clear picture to investors and financial analysts about the sources of funds used in the business and how they are distributed between assets and liabilities. This statement offers a comprehensive view of the company's ability to meet its debts and achieve future growth. Understanding the difference between a budget and a financial statement is crucial for both individuals and businesses. The terms are often used interchangeably, but they represent distinct financial tools with different purposes and functions, although they are related. A budget is a financial plan for future income and expenses over a specific period, often a year. It is a forecast that helps individuals or organizations allocate resources, plan for future needs, and control spending. Budgets are dynamic and can be adjusted during the period based on actual income and expenses. They provide a framework for financial discipline and decision-making. On the other hand, a financial statement, also known as a balance sheet, is a historical document that summarizes the financial position of an individual or organization at a specific point in time. It consists of three main components: assets, liabilities, and equity. The financial statement provides a snapshot of what is owned and owed and the net worth. It is used to evaluate financial health, manage debts, and analyze the performance over a period. While the budget is forward-looking and predictive, the financial statement is backward-looking and reflective. Together, they offer a comprehensive view of financial planning and performance. In the financial statements of businesses, the balance sheet, or statement of financial position, is a fundamental tool that reflects the financial condition of the company at a specific point in time. However, not all accounts appear on this statement. Some accounts that do not appear on the balance sheet include expense and sales accounts, as these are shown in the income statement. Additionally, profit and loss accounts have no place on the balance sheet because they are integrated into equity and reserves. Temporary accounts such as revenues, expenses, and other transactions related to the short-term financial period are part of cash flows or the income statement, not the balance sheet. These other statements help complete the overall picture of the company's financial situation. Financial statements, particularly the balance sheet, can be evaluated based on various key indicators to determine if they are strong or weak. A strong balance sheet often features a high level of assets compared to liabilities, implying good liquidity and financial stability. Key components that contribute to a strong balance sheet include a high current ratio, current assets divided by current liabilities, low debt-to-equity ratio, total liabilities divided by shareholders' equity, and consistent profitability and revenue growth. Additionally, having substantial cash reserves and diversified assets can also be indicators of a strong balance sheet. Conversely, a weak balance sheet may display a high level of liabilities in comparison to assets, indicating potential liquidity issues and financial instability. Key signs of a weak balance sheet include a low current ratio, high debt-to-equity ratio, and inconsistent or declining profits and revenues. Limited cash reserves and heavy reliance on debt financing can exacerbate these weaknesses. In summary, the strength of a balance sheet can be quantitatively assessed through financial ratios and qualitative aspects such as asset diversification and liquidity management. Besides the ratios, the industry context also matters. For instance, a tech company may have different standards for what constitutes a strong balance sheet compared to a manufacturing firm, due to the different nature of assets and liabilities inherent to those industries. Therefore, while financial metrics provide a snapshot, industry norms and context are also vital for a complete assessment.
In accounting, inventory refers to the goods and materials that a business holds for the purpose of resale or production. It is considered a current asset on a company's balance sheet, as it is expected to be sold within a year. Inventory typically includes raw materials, Items used in the production of goods, for example, wood for furniture. Work in progress, WIP. Partially finished goods that are still in production. Finished goods. Products that are ready for sale. Key concepts in inventory accounting. Inventory valuation methods. FIFO, first in, first out. Assumes the first items purchased are the first ones sold. LIFO, last in, first out. Assumes the last items purchased are the first ones sold. Weighted average. Averages the cost of inventory items. Specific identification. Used when the cost of each specific item is known, for example, unique or large items. Inventory turnover ratio. Measures how quickly a company sells its inventory. Calculated as inventory turnover equals cost of goods sold, COGS, / average inventory. Inventory management. Involves ensuring the right amount of stock is available to meet customer demand while minimizing holding costs. Accounting for inventory. Initial recording. Inventory is recorded at cost, which includes the purchase price, shipping, and handling fees. Cost of goods sold, COGS. When inventory is sold, its cost is transferred from the balance sheet to the income statement as COGS. Let's dive deeper into key areas of inventory accounting, including valuation methods, inventory management, financial reporting, and metrics. Inventory valuation methods determine how the cost of inventory is assigned to the cost of goods sold, COGS, and the remaining inventory. FIFO, first in, first out. Method assumes the first inventory purchased is the first to be sold. Impact. In periods of rising prices, FIFO results in lower COGS and higher inventory values on the balance sheet, which increases net income. B. LIFO, last in, first out. Method assumes the most recently purchased inventory is sold first. Impact. In periods of rising prices, LIFO results in higher COGS, lower ending inventory, and reduced taxable income. Example: if the same company uses LIFO, it assumes the $6 units are sold before the $5 units. C. Weighted average cost. Method calculates an average cost for all inventory items available for sale. Impact: the cost of inventory and COGS is smoothed out over time, providing a middle ground between FIFO and LIFO. Formula: weighted average cost equals total cost of goods available for sale divided by total units available for sale. Example: if a company has 200 units costing $1,100 total, the weighted average cost is $5.50 per unit. D. Specific identification. Method tracks the actual cost of each individual item sold. Usage used for expensive or unique items, such as cars or jewelry, where each item has a distinct cost. 2. Inventory management. Effective inventory management is crucial for controlling costs, meeting customer demand, and ensuring operational efficiency. A. Just-in-time, JIT, inventory. Method: inventory is ordered and received only when needed in the production process or for fulfilling orders. Benefit: reduces holding costs and minimizes waste. Risk: if demand forecasts are incorrect, stockouts may occur. B. Economic order quantity, EOQ. Method: a mathematical model used to determine the optimal order quantity that minimizes total inventory costs, holding, ordering, and stockout costs. Formula: EOQ equals SQRT, 2DS/H. Where D equals demand, units. S equals ordering cost per order. H equals holding cost per unit per year. C. Safety stock. Method: extra inventory kept on hand to prevent stockouts due to unexpected demand or supply chain disruptions. D. Reorder point. Formula: reorder point equals lead time demand plus safety stock. This ensures the company orders more inventory before completely running out. 3. Financial reporting and accounting for inventory. Inventory is a critical asset and is reported on both the balance sheet and income statement. A. Balance sheet. Inventory as a current asset. It is reported at cost or net realizable value, whichever is lower, under current assets on the balance sheet. Net realizable value, NRV. The estimated selling price in the ordinary course of business, minus costs to complete and sell. B. Income statement. Cost of goods sold, COGS. When inventory is sold, its cost is transferred from the balance sheet to the income statement as COGS. Gross profit. Gross profit equals revenue minus COGS gross. Profit equals revenue minus COGS. Inventory valuation affects COGS, which in turn affects gross profit and taxable income. C. Inventory write-downs. If inventory is deemed obsolete or damaged, a write-down may be required to reduce its value on the balance sheet. This is recorded as an expense in the income statement. 4. Inventory turnover ratio. The inventory turnover ratio measures how efficiently a company is managing its inventory. Formula. Inventory turnover ratio equals COGS divided by average inventory, where COGS, the cost of goods sold during a period. Average inventory. The average inventory held over the same period, calculated as average inventory equals beginning inventory plus ending inventory, divided by 2. Interpretation. High inventory turnover indicates efficient inventory management, but it could also signal that the company might not have enough inventory to meet customer demand. Low inventory turnover may indicate overstocking, poor sales, or inventory obsolescence. 5. Inventory accounting systems. There are 2 primary systems used to track and record inventory. A. Perpetual inventory system. Real-time updates. Inventory levels and costs are updated continuously as sales and purchases occur. Benefits: more accurate and up-to-date records. Usage. Common in modern businesses with automated systems and point-of-sale (POS) technologies. B. Periodic inventory system. Periodic updates. Inventory and COGS are updated at the end of an accounting period based on a physical inventory count. Benefit. Simpler but less accurate, relies on periodic counting. 6. Examples of inventory classifications. Manufacturing companies maintain raw materials, work in progress, and finished goods inventories. Retailers typically hold only finished goods ready for sale. To quickly recap, we've covered: mention the key points, for example, the different types of inventory, how inventory valuation impacts your financial statements, and strategies for effective inventory management. Understanding these concepts is essential for why it's important, for example, making informed financial decisions or running a successful business. If you found this video helpful, make sure to hit the like button and subscribe for more valuable content on related topics like finance, accounting, etc. And don't forget to leave a comment if you have any questions or thoughts. I'd love to hear from you. Thanks for watching, and I'll see you in the next video.
Accounts payable and accounts receivable are key components of a company's financial operations. Accounts payable represents the amounts a company owes to suppliers for goods and services purchased on credit. These are short-term obligations reflected as liabilities on the company's balance sheet. For example, if a business buys office supplies from a vendor and agrees to pay in 30 days, the amount due will be recorded as accounts payable until it is settled. This indicates the company's obligation to pay debts to its creditors or suppliers. Conversely, accounts receivable refers to the amounts a company is owed by its customers for goods or services delivered on credit. These are considered current assets on the balance sheet. For instance, when a company sells products to a customer on credit, the amount due is recorded as accounts receivable until payment is received. This reflects the revenue the company expects to receive in the near future. Essentially, accounts payable is about money going out, while accounts receivable is about money coming in. Efficient management of both is critical for maintaining healthy cash flow within a business. By ensuring timely payments for accounts payable and collecting payments for accounts receivable, companies can manage their working capital more effectively and avoid cash shortages. Understanding AP and AR in accounting and the accounting treatment between IFRS and GAAP. Under both International Financial Reporting Standards, IFRS, and Generally Accepted Accounting Principles, GAAP, the treatment of AP and AR follows similar underlying principles with slight variations in detail and presentation. Accounts payable represents the amount a company owes to its suppliers and creditors for goods and services received. These are considered current liabilities on the balance sheet, typically due within a short period, usually under a year. In IFRS, AP is recognized at its nominal value unless a discount is applied for early settlement, in which case the effective interest method is used. Similarly, GAAP requires AP to be recorded at the invoice amount, with adjustments for any discounts or credits received. Both standards emphasize the importance of timely and accurate recognition to reflect true financial standing. Accounts receivable, on the other hand, signifies the amount owed to a company by its customers for goods and services delivered on credit. This is presented as a current asset on the balance sheet. Under IFRS, AR is measured initially at the transaction price and subsequently at amortized cost, using the effective interest method, if applicable. An allowance for credit losses is also recognized, following the expected credit loss, ECL, model, ensuring a realistic valuation. GAAP uses a similar approach where AR is recorded at the invoiced amount, and an allowance for doubtful accounts is established, often calculated based on historical data and foreseeable risks. The main distinction lies in the methodology for estimating credit losses, with GAAP traditionally being more conservative. Both IFRS and GAAP aim to provide a clear representation of a company's financial obligations and entitlements. While the foundational principles are consistent, the specific criteria and methodologies for recognition, measurement, and presentation can vary, reflecting the slight differences in the frameworks. Understanding these nuances is crucial for accurate financial reporting and analysis. In the dynamic landscape of modern business, there are increasingly diverse operational models. Among them, some companies chose not to have accounts receivable, AR, or accounts payable, AP, as part of their financial structure. This might seem surprising for traditional business models where AR and AP play critical roles in managing cash flow, customer relationships, and vendor interactions. However, businesses adopting a zero AR/AP model generally operate on a cash basis, either receiving immediate payment for their services or products upon delivery and paying suppliers and vendors upfront. This approach allows these companies to maintain a cleaner balance sheet, reduce risks related to credit and debt collections, and improve their cash flow management. Many small businesses, particularly those in the service sector or direct-to-consumer retail, have found this model conducive to their operations. Instead of chasing down overdue payments or managing extensive payables, they streamline their processes for efficiency. Additionally, the advent of digital payment systems and e-commerce platforms has enabled these companies to operate smoothly without traditional AR and AP, leveraging technology for instant transactions. While this zero AR/AP model might not be suitable for every business, it highlights the importance of flexibility and innovation in financial strategies to align with specific business goals and market conditions. By eliminating the complexities associated with credit terms and invoicing, these companies can focus more on growth, customer satisfaction, and strategic investments, proving that traditional business processes can indeed evolve to meet modern economic demands.
Are you tired of making the same mistakes in trading? Or maybe you're just starting out and wondering how the pros consistently stay ahead in the markets? Whether you're a beginner or an experienced trader, the key to success isn't just luck, it's skill, strategy, and discipline. In this video, we're breaking down the exact steps that will take your trading skills to the next level. From mastering technical analysis to controlling emotions, we're covering it all. Ready to transform your trading game and make smarter moves? Let's dive in. 1. Study the market and strategies. 1. Technical analysis. This involves studying price charts and using indicators like moving averages, RSI, Relative Strength Index, MACD, Moving Average Convergence Divergence, Fibonacci Retracement, etc., to forecast price movements. 1. Books like Technical Analysis of the Financial Markets by John Murphy are invaluable. 2. Fundamental analysis. This focuses on the economic and financial factors influencing an asset's price. 2. For stocks, this includes analyzing financial statements, income statements, balance sheets, etc., and economic factors like interest rates, inflation, and employment data. 3. Understand different markets. Study how various markets like stocks, forex, crypto, and commodities behave, as they can be influenced by different factors such as geopolitical events or global economic indicators. 2. Practice with a demo account. 1. Benefits. A demo account simulates real market conditions without the risk of losing money. 1. It helps you become familiar with your trading platform, test strategies, and build confidence. 2. How to use it. Practice different strategies. Learn how to place orders, market orders, limit orders, stop loss, and refine your trading plan before moving to live trading. 2. Make sure to treat it like a real account to simulate actual trading conditions. 3. Develop a trading plan. 1. Components of a good plan. Your trading plan should include market to trade, stocks, forex, crypto, etc. Trading strategy. The criteria you use for buying and selling, e.g., breakouts, moving averages. Risk management. Define how much capital you are willing to risk per trade. Trade management. Plan your entry and exit points, including take-profit levels and stop-loss orders. Psychological discipline. Stick to your plan even when emotions come into play. 2. Why it matters. A structured plan helps you avoid impulsive decisions and stay consistent with your strategy. 4. Risk management. 1. Position sizing. Don't risk more than 1–2% of your trading capital on a single trade. 1. This ensures that even a series of losses won't deplete your account. 2. Use stop-loss orders. Automatically close losing trades when they hit a certain price. 2. This protects you from large losses. 3. Diversification. Don't put all your capital into one trade or one market. 3. Spread your risk across different assets or sectors to reduce exposure to a single event. 4. Risk-reward ratio. Aim for trades where the potential reward is at least twice the risk, 2-to-1 ratio. 4. For example, if you risk losing $100, the potential profit should be at least $200. 5. Keep a trading journal. 1. What to record. Document each trade's entry and exit points. Reason for taking the trade, outcome, profit or loss. Emotions felt during the trade, lessons learned. 2. Benefits. Over time, a trading journal helps you analyze your trading patterns, avoid repeated mistakes, and refine your strategies. 2. It also builds discipline and accountability. 6. Specialize in a few markets. 1. Mastery. Specializing in a specific asset class or market, e.g., forex, commodities, or stocks, allows you to develop deeper insights. 1. Each market has its own nuances and factors that influence price movements, so focusing on one or two markets helps you become more proficient. 2. Market hours. Different markets have specific hours that are best for trading. 2. For example, the Forex market is open 24 hours, but the best trading opportunities are during peak hours when liquidity is high, such as the overlap of the London and New York sessions. 7. Backtesting. 1. What it is. Backtesting involves applying your trading strategy to historical market data to see how it would have performed. 1. It helps identify weaknesses in your approach and gives you confidence in your strategy before using real money. 2. Tools for backtesting. Platforms like MetaTrader, Thinkorswim, or TradingView allow you to backtest strategies on historical data. 2. Ensure the backtest period includes both bullish and bearish market conditions for comprehensive results. 3. Limitations. Backtesting shows past performance, but market conditions can change. 3. Use it as a guide but continue adapting your strategy as new data emerges. 8. Control emotions. 1. Emotional traps. Fear can make you exit trades too early or avoid taking trades altogether. Greed can make you hold onto a trade too long, hoping for more profits, which often leads to losses. Revenge trading. After a loss, you may try to recoup it quickly by entering risky trades without proper analysis. 2. Mindset training. Practice mindfulness, deep breathing exercises, or even maintain a trading mantra to help keep emotions in check. 2. Some traders use automated strategies to remove emotional decision-making from the process. 3. Take breaks. If you've had a streak of losses or emotional trading, take a break to clear your mind before resuming. 9. Continuous learning. 1. Market evolution. Markets are dynamic, and new tools, strategies, and regulations are constantly emerging. 1. Stay informed by reading trading books, attending webinars, and participating in courses on trading platforms. 2. Follow experts. Engage with traders who have more experience. 2. You can follow trading mentors on YouTube or social media platforms for insights and strategies. 3. Improve strategies. Don't be afraid to tweak your strategy as you gather more data on what works and what doesn't. 3. Even the most seasoned traders continuously refine their approaches. 10. Join trading communities. 1. Why join? Networking with other traders allows you to share insights, discuss strategies, and gain feedback on your trades. 1. These communities can also be a source of moral support, especially during challenging times. 2. Where to find them? Platforms like Reddit's r/Daytrading or r/Forex, StockTwits, and Discord channels host active trading communities. 2. Be cautious, though, while these spaces can provide valuable insights, always cross-check advice with your own research. These detailed steps will not only enhance your trading skills but also help build the mindset of a disciplined, educated, and resilient trader. And there you have it, the tools and strategies to sharpen your trading skills and take control of your financial future. Remember, trading isn't about winning every time. It's about learning, adapting, and consistently improving. Success in the markets is a journey, not a race. If you found this video helpful, don't forget to give it a thumbs up and hit that subscribe button for more tips on mastering the markets and growing your financial knowledge. And hey, if you've got questions or strategies that work for you, drop them in the comments below. I'd love to hear from you.